see how long it takes here. There we go. And what I want to do is go to the application, which is going to be OptionView 7, my software program. And I now have OptionView 7 in a mode that hopefully you are able to see on your screen as well. Is that
yes,
correct,
we
Chuck?
can see it, and yes, we can. And for everybody listening in, Paul's going to be in see the chat, so he'll do his presentation, come back at the end to answer questions. So please feel free to type your answers in, but please respect the fact that right now, because of technical issues, we've got everything where he's not seeing the chat. So please be patient with us as we go through this presentation. The room is all yours, Paul.
Thank you very much. My name is Paul Forcioni. I'm a trading coach with Discover Options, which is the educational division of the OptionView software company. And what I want to do for you is to show how I use software with respect to what I consider to be a unique options strategy that can be employed in selected futures and commodities markets. When I say selected, I'm really referring to large markets in the futures and commodities area. As I go through the presentation, I think it will become clear why. This trade strategy, which I call a vertical swap options strategy, is a technique to trade with low margin requirements and to trade in a very risk-averse way. I say risk-averse and low margin because this is a way of managing your delta exposure. It keeps your gamma exposure low, so your deltas don't change dramatically when the market moves. And most importantly, it is a way of managing your volatility risk, implied volatility risk in the marketplace. These positions I'm going to show you have low Vega. In addition, these positions have positive time decay, positive beta. So that's the introduction. Let's get into specifics. We're looking at the quotes display for OptionView, and I've got the gold market that I'd like to start with, gold futures. The quotes display is showing that the gold futures right now are essentially at the 1730 level. So when we use OptionView to look at the matrix for gold, we can see there are December, February, and April gold futures available. There's even more. These are the ones I have displayed. And we have January, February, March. We have April. There's a lot of options, a lot of option expiration months to choose from. What I'm going to do is start by working with the January options that expire in 37 days. These options are tied to or related to the February gold futures. And if we wanted to create a position in gold, first thing we would do is take a look at the price chart for gold. And what we have is a bar chart of historical prices for gold futures contracts, and superimposed on top of that are some colored lines. The colored line I'd like you to look at right now is the blue line. You can see it's very jagged in its behavior, and that is a reading of implied volatility for all of the gold options as a composite for various points in time. Whatever date you happen to highlight, you can get a reading for what gold implied volatility is. Clearly, there is no discernible pattern between rallies in gold futures and movement of implied volatility. Sometimes gold rallies and implied volatility goes up with it. Other times gold rallies and implied volatility declines. Depending upon the options strategy that you choose, most option strategies have a significant exposure to implied volatility. Not the strategy I'm going to show you today. Let's assume that we wanted to be bearish on gold as a starting point. As I say, we're going to start with the January options. I'm going to go to the at-the-money strike price. That would essentially be the 1730 strike price call. Why do I choose the at-the-money strike? Because at-the-money options have the most time value. And when you sell an at-the-money option, you're going to have a lot of positive time decay. Now what I want to do is go out of the money, and I'm going to go all the way to the 1800 strike and buy one of those. In other words, I'm going to create a credit call spread, or what you could call a vertical spread. Very common spread that people use all the time. This is the graphic analysis feature of OptionView, and it shows you with a series of timelines, and I'll change the color on these timelines. It shows you with a series of timelines, in this case 4 of them, how this vertical call spread can perform over a range of prices, both to the downside and up, as well as over the passage of time. So the T+0 performance curve is today's curve. If you go 12 calendar days in the future, that would be T+12. 25 days in the future is here, and expiration of the January options is 37 days from now. What you notice, though, with all of these timelines as you approach expiration is when you look beneath the graph at the what are called Greek variables, the Vega factor is negative. It's quite negative regardless of how far the market drops or how far the market rallies. That means the Vega factor is a number that represents dollars of impact. It's telling us that right now, at this very moment, today, the call spread is minus $88. If implied volatility changes by 1 percentage point, it has an $88 impact on this spread. And that $88 is a profit if implied volatility declines by 1 percentage point. The $88 is a loss if implied volatility increases by 1 percentage point. That's on this vertical spread. However, what we want to do is hedge this. So we're going to go from January and we're going to jump out to March, 2 months further into the future. And we are going to put on the exact opposite position, which means I'm going to buy the 1730 close to the money call, and I'm going to sell the 1800 out of the money call. That would be a debit vertical spread or a bull call spread that has a graphic analysis that looks like this. Both of these trades together, if you put both of these positions on, then you would have a spread position that I refer to as a vertical swap position, a vertical swap. We have a credit vertical spread in the month of January. We have a debit vertical spread in the month of March. And it creates a very interesting position because now what this is telling us is that we do have a modestly bearish position. It starts off with a delta of minus 13.95, let's say minus 14 deltas. So in the short run, movement in the underlying gold futures will be reflected in performance of this spread to the extent of 14% of the move. And clearly we want the market to move lower because we're delta negative. And we stay delta negative for quite a long ways on the downside. Level, this position has a theta or time decay of 10.48. It's essentially $10.50 of positive time decay. The longer we hold this trade, the more positive time decay will grow. If I click on the next performance curve, T+12, you can see that the theta grows to $17.50 a day. If I click on the next T+25 line, from now, the theta grows to $39 a day. So the longer you're in this trade, the more you generate income from positive time decay. In addition, as I mentioned before, if gold futures decline, the profit on the position tends to grow, as represented by the P&L line immediately below the graph, because you're also getting benefit of your negative deltas. So, when a near directional bias was bearish, you can take advantage of that by structuring the trade this way. Clearly, if the market moves to the upside, you will tend to lose money in the short run, but the losses are rather modest because your delta position is rather modest. And if time goes by before the market rallies to, let's say, the 743.5 level, you will still have a very modest profit. The thing to note, the sensitivity of this position to changes in implied volatility is very small. The Vega factor starts off as positive 10, 10.5, a minus 44, minus $44. And as the market changes in direction, it stays at about the same level. That's $44 of, if we advance the clock to 25 days from now, that volatility sensitivity at an unchanged level is about the same. And if the market moves in the direction that we wish, the Vega factor is very, very close to zero at the 1702 level. It's actually only $3.77. If the market happens to rally quite a bit, the Vega factor is even smaller than where it is currently. It's only minus $14. So this is a strategy that manages your exposure to volatility. It's primarily a strategy that allows you to take advantage of your directional bias, and it takes advantage of the passage of time. So whether the market stays where it is, or in this case moves lower, you make money. The only way you lose is if the market moves significantly against your directional bias. Now, let's say that we did have the market move against us, and it rallied up to the, let's say, 1751 level. And let's say that it took 12 days to get there. This is telling us our projected loss is $320. And our delta bias is minus 23. Now you could say, well, I was wrong about gold. I'll close the trade, take my loss, and figure out something else to do. But if you feel that this is the beginning of something significant in the way of a trend to the upside, you have the ability to very easily modify this trade so that now you will take advantage of the market staying at the 1751 level, or take advantage of the market continuing to rally to the upside. And it's very easy to figure out how to do that. I'm going to go back to the matrix to show you. When I close this, if you think of the spreads and the vertical debit spread in March, if you put on a different pair of glasses and you look at it in terms of calendar positions, what do we have? We have a short 1730 January call relative to a long March at the same strike, 1730 call. That, by definition, is called a calendar spread. And it happens to be an at-the-money calendar spread. You could say that we also have a reverse calendar spread at the 1800 level because we're long the front month in January, short the deferred month in March. So think of this spread as a calendar spread along with a reverse out-of-the-money calendar spread. So to switch the bias on this position, all we really need to do is to close the out-of-the-money reverse calendar spread, which means we sell the January 1800 call and we buy the March 1800 call. We close that spread. And now we replace it with a reverse calendar spread using puts. So let's go to the 1625 level and buy the 1625 put in January, sell the 1625 put in March. Now let's take a look at our position. Now notice how, I'll change the color so it's more visible. At the 1752 level, we now have a position that is modestly bullish. and we've eliminated our exposure on the upside. As time goes on, the trade can definitely generate additional profits. Those profits would compensate for the initial loss on the market running against our initial position and allow us to recover that loss and then turn profitable over time. What I call flip the position, so that now we have a neutral to bullish position going forward in time. Notice the Vega factor, -3 at this level. Very, very small number. And even if the market continues to rally, the Vega factor is still rather small in relation to the profits that are building. So the objective here is to use options, but to use options to capture positive time decay, to use options to rein in the risk of losing money because of an inaccurate guess on implied volatility. What we really have here is a situation where it is, you could say, a race between the passage of time and which way and how far the market is going to move. But we don't have to be overly concerned with implied volatility. And that really is, in my opinion, what most people overlook. Implied volatility is like high blood pressure. It's the silent killer. People can oftentimes buy a call or buy a call spread. The market rallies in the direction they want, and they lose money. Why is it? Maybe the move wasn't big enough, but oftentimes implied volatility went the wrong way, and it caused the position to lose money. Now watch what happens with this position if we go back to the position that we had originally. I will put that in. This is our original position with a modestly bearish bias. Watch what happens if we want to be a little bit more aggressive. What would that really mean? Well, there's different ways of becoming more aggressive so that your deltas are more negative. And one of the ways of doing that is to take a look at the March options and to narrow this spread. Narrow the debit spread, our insurance spread, to be, what we have is a position that starts off more delta short. So we get immediate benefit as the market moves down because our deltas are greater. And of course, we still get even greater positive time decay because we are narrowing the amount of money that we're spending in the deferred month of March. The other impact of narrowing the March debit spread is that we now will take on a higher degree of Vega exposure. So by putting less insurance in place in the month of March, now we are exposed to a larger Vega factor. So that's one of the things to keep in mind with this. But you can play around with different strike prices to get the shape curve that really fits your eye. Not only that, but you'll notice I used January and March. What if I would use January and February? Lower risk, lower margin trade. Previous trade had margin of about $2,300. The margin on this trade is about half that, $1,262. We have a smaller negative delta starting out because we are using months that are next to one another, January and February, rather than January and March. We still benefit from the market moving lower. We still benefit from the passage of time. And you can see in 25 days, which is essentially 3.5 weeks, even with a very modest decline in the market, or if the market is, say, $400 to $500, are a very high return on the margin that's required to establish the trade. So you might say to yourself, well, I'm not a trader that's interested in only like a $400 or $500 profit in 3 weeks. I want something more. Well, all you need to do is put the trade on more than one time. If you put the trade on 5 times, for example, everything is multiplied by 5. The margin becomes 5 times this. It would be about 6 grand in margin. The projected profit would be anywhere from 2,000 to 2,500. The return on margin would still be the same, essentially, maybe about 40% return on margin in 3.5 weeks. Your theta, your Vega is 5 times this. But finding the spread that looks good on a one lot allows you to then decide, based upon money management principles and based upon your account size, how many times you want to put the trade on. This is a type of trade that you can even scale into. You can start with a January and a February spread. The January options only have 37 days of life, so as those options get closer to expiration, you really don't want to hold this trade until the bitter end, because what's wrong with capturing a, say, 40% return on margin in 25 by holding for another 12 days? And that could be, very advantageous. But what happens if you're sitting at this level and now the market starts to rally? Well, you can see that your profits will start to dissipate. And then it really does become a coin toss. It's a race between how fast will the market rally and how much time, do you have to make that additional time decay. I always advise people to definitely close their positions at least 10 days, perhaps even 15 days prior to expiration, because then you avoid what is called the gamma risk. The gamma risk is that your deltas will tend to move against you the closer you get to expiration when the market moves in an unfavorable direction. But I've always felt that these types of graphic analyses at options valuable tool because it is a time-lapse picture of how your spreads can do as the market moves and as time goes by. And if you're wondering why does it show a $530 profit after 25 days at the level 1711.90, well, it's not guesswork. The program tells you exactly how that happens by going to the detailed analysis, clicking on the little D box on the lower right-hand corner, exactly why the spread makes $530 in this case. It shows the individual prices you got into each option. It shows their theoretical prices at this point in time, 25 days in the future, and then calculates the dollars of profit or loss on each one. Option View also does give you the ability to put in changes in implied volatility assumptions. You can put them in here and have the program simulation or a projection by taking the Vega factor into account. So Option View does provide tremendous versatility in constructing these types of trades. Now I've showed you the gold market. You can do this in any futures or commodity market that is large in size. The gold market is essentially $173,000 in underlying dollar value, because gold is priced at $1,730 and one futures contract represents 100 ounces of gold. And the reason we like high size markets is because we want to be able to obtain a lot of positive time decay by selling the at-the-money option. I've shown you a bearish position in gold. If I were to show you a bullish position in gold, we would, instead of using calls, the at-the-money put as a starting point, for example, the 1730 put in January, and we would then hedge that by purchasing a further out-of-the-money put. Let's go to the, let's say, 1675 put. And then what we could do is the opposite position in the month of March. And now when you look at the graphic analysis, you've got your bullishly oriented trade with a very small negative Vega factor. And as time goes on, that negative Vega factor stays small and actually gets smaller as the market moves in the direction that you desire. And it actually gets smaller when it moves against you as well. So you have complete flexibility in how you start your position and then how you can flip it, as I say, to change the direction. In this case, the flipping would involve that we have with the out-of-the-money strikes, closing that, and putting on a reverse calendar spread with the opposite type, which means calls. We could go to the, let's say, out-of-the-money 1800 call by buying that and selling the March. And now we've changed our bias from being bullish to being negative, to being bearish. So that's the gist of it. You can try this in markets that are large, like currency, the silver market, the Japanese yen, crude oil, soybeans. E-mini S&P is perhaps just large enough to do it in. A whole variety of markets, probably about 8 to 10 markets are ideal for this strategy. So that's the presentation. Now I'm going to close this and go back to see if there are some questions that you folks would like me to answer. And I see, so let's see here. Starting at the top. Okay, well, I think I've covered this. Could it be done with a bullish bias, which is a bull put spread? The answer is yes. We start with a bull put spread in the front month, or at least a given month, and then we put on the bear put spread in the deferred month. Is the 1800 strike that I chose based on any resistance? Well, no, I was not really selecting that based on resistance. I was actually choosing that strike because I wanted to create a wide enough credit spread to achieve positive time decay that would build over time. But you can certainly structure the trade based upon whatever support and resistance that you're looking at. That would be the starting point to determine whether you want to be bullish or bearish. And 40% return on margin, yes, that was correct. That's what we were looking at in about a 25 calendar day period if the market were to cooperate and either be at a slightly higher level on the bullish position or a much higher level. As long as the market didn't move significantly against our bias that we created when we put the trade on, that 40% was an achievable target to shoot for. Let's see, what would the effect be if implied volatility jumps up early and big after putting on a spread? Well, the effect is rather tempered. That's what the Vega Factor tells us. If the Vega Factor is minus, say, 30 starting out, minus $30 for a 1 percentage point change in implied volatility, and let's say there was a 5 percentage point change immediately, if it were to jump up, that would be 5 times 30 or $150 loss on the spread. If it moved down, that would be a $150 profit on the spread, separate and apart from positive time decay and separate and apart from the impact of market movement. But the whole idea here is we want the effect of implied volatility to be tempered compared to other spreads. If you did a simple vertical spread, like I showed at the very beginning, the Vega Factor is much more negative than on the vertical swap trade. If you were to do a calendar spread or a butterfly trade, the Vega Factors are enormous on those positions. And that's where most people end up really getting hurt, is they don't realize how big the sensitivity to volatility is on those other types of trades. Okay, what other questions do you have? I think I've gone through these. If there are no other questions, let me give you a couple of sites here. OptionView.com is the website for the OptionView software. I've been using it for 17 years myself. A fantastic piece of software for retail options traders, whether you're trading options on futures, options on equities, options on ETFs. It works on all of that. And then I also have my personal website, where I have a lot of educational material that is available for options. I do see another question here. Would putting both the bull put and bear call spread together capture more time decay? Well, yes, it would. You could do the bull put spread in the front month. You can do the bear call spread in the front month. You would basically have then either an iron butterfly or an iron condor, depending on the strikes that you choose. And then if you do the opposite positions in the deferred month for both the puts and the calls, you would really have a vertical put swap along with a vertical call swap. It would be a delta neutral position with a lot of positive time decay, little sensitivity to implied volatility, and you could manage that trade as a delta neutral position with little volatility sensitivity. Yes, that is a possibility. I personally like to just choose a direction one way or the other and go from there, but it is possible to do both, as you say. My time is up, but I will answer the last question. OptionView is not a brokerage firm. It is an options analytical software company, and it also has, as I say, the educational division, discoveroptions.com. Thank you very much, everybody.